It would be like getting into your car and pressing the brake pedal and the gas pedal at the exact same time. It makes no sense. And this is causing a massive political crisis. Hi guys, it's Stock Curry, and just one day after the market fell below the June lows, it went on a massive rally. In today's video, I'm going to explain the strange news that triggered that massive rally and what it means for the future of the stock market. So let's get into it! On Tuesday, the S&P 500 fell to a new 52-week low, closing below the June lows. This happened after home prices cooled in July at the fastest rate in history. We also saw the 10-year Treasury rise to over 4%, and all of this bad news combined sent the stock market tanking on Tuesday, with the S&P closing at a new 52-week low. But then on Wednesday, the stock market rallied, jumping over 4% from the pre-market lows. This happened after the Bank of England intervened in the bond markets because they were seeing an historic sell-off in their bond markets. Keep in mind that as bond prices fall, bond yields rise. Now, a yield is another term for an interest rate. So as bond prices go down, interest rates go up. Now, the Bank of England had been trying to raise interest rates in order to fight inflation, so it made sense for the interest rates on bonds to start rising. The problem is the bond sell-off was so extreme that interest rates were now rising at the fastest rate in over 60 years. And that scared the Bank of England. So what did they do? They started buying bonds. Now, as the Bank of England buys bonds, this has the effect of lowering the interest rate on bonds. This is known as quantitative easing. And quantitative easing, or buying bonds, is a way of lowering interest rates when you're trying to stimulate your economy and get it out of a recession. The UK's decision to buy bonds and lower their yields caused global bonds to rally. As bond prices all over the world rallied, this caused our own US 10-year Treasury yield to drop by the most since 2020. Now, the UK's decision to step in and try to settle the debt market was really strange. And there are concerns that this is going to threaten the entire global economy and cause a political crisis. This uncertainty is continuing because there's a clash between what the government and the markets want right now. You see, the Bank of England is doing this quantitative easing or trying to lower interest rates on the bond market at the exact same time that they are raising their federal funds rate. On one hand, they're raising interest rates in order to fight inflation and slow down the economy, and at the exact same time, they're buying bonds to lower interest rates and stimulate the economy. It makes no sense. It's the complete opposite monetary policy occurring at the exact same time. It would be like getting into your car and pressing the brake pedal and the gas pedal at the exact same time. It makes no sense. And this is causing a massive political crisis in the UK right now. So while this might have helped the bond market and the stock market in the short term, in the long term, this is causing a crazy crisis, and the International Monetary Fund, as well as the World Bank and many others, are raising red flags about what this is going to do to inflation and how the markets are going to react to this political crisis in the future. We don't know what this is going to bring out. Certainly, it did raise the markets on Wednesday, but what it does in the long term is still to be seen. And a lot of people are fearful that this is actually going to cause a major recession, and it's going to cause a recession to be a lot worse than it would have been otherwise. Now focusing on what's happening in the United States, Tensions continue to rise in the West Coast ports as unions and management continue to be without an agreement. They're going into 4 months now of negotiations without an agreement between the unions and the management teams. This is causing fears that the West Coast ports might be shut down, and in fact, we're already seeing slowdowns and reduced cargo handling as a result of worker disruptions. If this continues much longer, it's going to create new supply chain issues, which is going to restart an increase in inflation here in the United States. We also expect rent prices to continue to increase throughout 2023, which will further cause inflation to continue to rise. As inflation continues to rise, the Federal Reserve, or the United States Central Bank, will have to continue to raise interest rates in order to fight inflation and get inflation down. Now, this is causing a lot of people to be fearful about an upcoming recession. The question is no longer, are we going to get a recession? The question now is just how deep will that recession be? Ken Griffin says the Fed has not done enough and it must continue on its path to reset inflation expectations. In other words, Ken Griffin says the Fed is going to have to continue to raise interest rates at a significant rate in order to get inflation down. And this could cause a recession to be much worse than currently expected and could cause the stock market to continue to fall. Stanley Druckenmiller took it a step further, saying he sees a hard landing in 2023 with a possible deeper recession than many people expect. Now, I don't want to scare you because with any future outlook, there's always going to be a difference of opinion. PIMCO's Ivonskin sees a mild recession ahead and several investing opportunities. He specifically sees investment opportunities in fixed income and high-quality emerging markets, as well as mortgages and banks. So to be clear, outside of banks, he does not see investment opportunities in the stock market. He sees investment opportunities in bonds, which are currently paying pretty high yields, as much as 6%. And he also sees investment opportunities in mortgages, which would be mortgage-backed securities, which is another type of bond. And JP Morgan's Erdis is even more bullish, saying in this turbulent market, there are opportunities everywhere. Certainly, as the stock market has continued to fall and the bear market has continued onward, opportunities have become more and more abundant. Every other week on Fridays, I have been buying value stocks in a Millionaire Club challenge. If you want to follow along on that challenge, I have a link to the playlist for that on my YouTube channel. The challenge is completely free. All you have to do is watch the YouTube videos. If you want to make sure you don't miss any of the upcoming videos, including what I'm going to be buying on Friday, make sure you hit the subscribe button and click the bell icon so that you don't miss any of the future video announcements. Now, in the short term, I do expect the markets to continue to fall. Over the next couple of days, we'll probably get a little bit of a rise. The S&P 500 looks like it wants to go up about another 2 to 4% before topping out. The reason is it was oversold on the RSI, and we need a little bit of a breather here before we continue downward. However, because we did hit a new 52-week low on Tuesday, I do expect the S&P 500 to continue to fall. Now, taking a look at the SPY, which is an S&P 500 ETF, the next support level is at $344. That's about a 7% drop from Wednesday's close, or about 5% below the June lows. Now, that's just what I see in the short term. Longer term, the S&P 500 does have some lower support levels that it could certainly get down to. It's very difficult to tell just how far the market is going to drop. I've talked about how in prior videos, historically, October is the macro bottom for a bear market, with the market rising in November and December. However, if we do go into 2023 and we do enter any sort of major recession, we could see the stock market continue to fall further. That said, if the Federal Reserve changes course, and they start doing what the Bank of England is doing, and they say, whoa, we're entering a recession, we don't want to enter a recession, and they start stimulating the economy. If the Congress starts to print money, if the Federal Reserve decides to lower interest rates, if the Federal Reserve decides to stop their quantitative tightening and switch back to quantitative easing, if any of those things occur that causes interest rates to go down or the money supply to increase, that will cause the stock market to do a complete 180 and start going back up. Even if we're in the middle of a deep recession, even if all the news is bad, if the Fed starts getting bullish and starts stimulating the economy, the stock market will rise. That is why very often you will see the stock market start to rise about 6 months before the end of a recession, because it takes about 6 months from the time the Fed starts to stimulate the economy until we come out of a recession. So don't be looking at the news for the bottom of a market. Look at the Fed for the bottom of the market. If you enjoyed these videos and get a lot out of them, be a good friend and share this video with your friends and family so that they can learn how to invest as well. And if you want more information on what's going on in the markets, as well as a few stock picks that I think you should take a look at and possibly consider buying the dip on, make sure you check out the video that I uploaded yesterday.